Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session. And we are going to go ahead and get started today. We've got a lot to cover as normal, where it's a little bit different today because the current market action has kind of changed our focus a little bit. As you well know, we were going to cover option insanity today, and we will cover it a little bit, but I'm going to cover it in under the context of why we aren't going to be taking any option insanity trades this week, any of the lower risk option insanity trades this week. And I think a lot of you understand that when volatility is pushed up, when the market is kind of on the way down, is a that's an indication that the option insanity is not going to be as valuable to us. And so we will go over some of the patterns, the option insanity patterns. I'm going to show you something from last year uh, and just show you the guide or a type of a guide, I guess, that you can use to determine the validity of these trades. And then I'm going to introduce something else at the end of the call. Depends on how much time we have with regard to how much time I spend on it. But I know it is something that has interested many of you for a while, and I just haven't gotten to it. And it is called my cash flow spread. Some of you know what that is, some of you don't. Cash flow is a little bit different type of approach well, we'll get to it. I'm not going to explain it right now. I'll explain it here in a minute. All right, so those are the two things that we're going to focus on today. We also normally focus on exiting trades, but with the market down, it's like there's really nothing to do because we do credits on everything. I do a credit on everything except you can see here this cash flow spread. Cash flow spread isn't a credit, but all the crazy calendars, all the uh, risk-free calendars, all of that type of stuff we do as credit. And when the market moves down, it obviously creates a scenario where you can take the profits early. You can hedge. You can do all sorts of stuff. So we'll cover a couple of trades that I got into, and then we'll go from there. All right. For those that are new on the call, I do want to welcome you, and I know we have a few new people on the call, so I do want to welcome you. But I also want to warn you that I don't explain everything about these trades on the call, nor can I. It's impossible for me to do that. We talk about basically this is an open forum for no, I can't say open forum. It is anything goes if it works in SPY weekly options. that's kind of what this is really all about because there's three types of volatility in SPY: low, high, and in between, right? And so there are different opportunities that exist in different market conditions. So we focus on if it can be done with SPY options and you can create low risk, high probability trades, then we are going to look at it and consider it. So, given that, as you can imagine, you're not going to walk away from this call understanding everything that we are discussing on the call because we discuss several trades, several different approaches on every call. And it's based on trades that were taken in the call, during the call, or am looking to take during the call or shortly after the call. So do not attend this call thinking that you're going to understand everything about these trades. You won't. They are meant to be cumulative, not a one-off. So um, uh, mark your calendar and just plan on attending consistently. It'll be great. I also want to warn you that a lot of these trades are fantastic, but they are not the holy grail. There is no such thing. This is not none of the strategies that we talk about start off with absolutely no risk. We often talk about how to get them to no risk, but none of them can start off with no risk. And you have to be willing to accept the risk of any spread that you take, any trade that you take. And because of that, you need to make sure that you start small so that you understand what you're doing. You don't make mistakes with the big lot size. I don't care how big your account is. You start small. You start with one. I say this all the time, and traders come in, $100,000 account, and they think they understand it. They take a 10 lot, a 15 lot, a 20 lot, make a mistake, and then wish they had only done a one lot. I can't tell you how many people say, I came in, I didn't really listen to you when you said that. I did this and I did that, and guess what? I went back down to a one lot. I cannot tell you how many traders have done that. So, wisdom is start with one, and then as you grow the account, as you prove that you understand it and that it's working for you, then you increase trade size. And you don't need to worry about your big account right now with regard to this, because all you have to do is average a little bit every week, and you can grow a small account into a large account over time. And even if it's only $10 a week, you're talking about a monster growth over a 5-year period. And I put 5,000 in here. If you're going for $10 a week, you're probably trading a really low risk approach, and you can probably do that on a much smaller account than a $5,000 account. But $10 a week compounded according to the trading plan that I'm about to show you can grow your $5,000 account into $35,000 in 5 years. $20 a week. Look at if you just increase that, if you're able to improve on your weekly average, and that's really the goal. You start with gain something on a weekly basis, and then try and improve it. And if you can improve it a little bit, it has a huge effect in the long run with regard to the compounding. So $20 a week grows into 135,000. Get up to $50 a week, you're talking about almost $1 million after 5 years. And if you're able to get to where you're averaging $100 a week in a low risk strategy, you're talking about multi-million-dollar account in 5 years. So that's why I say start small, because you don't need to start big. As you prove what you're doing, the compounding will help you out there. Here's the compounding plan that you can use for most of the approaches. You can also be a little bit more conservative, or maybe a little bit more aggressive, depending on what it is that you're doing. And as long as you understand the compounding approach, and after 6 months, if you can get to where you're averaging $100 a week, you're talking about growing an account, all the way to 32,000 in just 6 months. So that is certainly something that is a potential. Once you really start to understand what you're doing and get into a rhythm and being consistent with how you're doing it. And this is the same compounding table that grows the account to almost 3.4 million if you are able to average $100 a week over the next 5 years. All right, so some of you have asked about the fund and what the fund is doing with SPY coming off a bit over the last several days, pretty much all week. And here it is. So again, I've been taking the daily equity of the fund versus SPY. And so we did take a little bit of a dip yesterday. Things kind of settled down a bit today, and we're still up about 3.5% since I started taking the daily equity on this thing. And if you're not familiar with it, it basically focuses on option premium selling, and then also on a smaller degree some of the spreads that we talk about in this webinar. And this is the one that I focus on as far as the fund is concerned, because it does bring in a credit. So if markets come down, because I'm selling put options basically, but if the market, if stocks come down, then I've got a little bit of a credit going on with the option insanity trades. And of course, this is the option insanity trade that I took. Now, I reference this one every week. And why do I do that and not all of the other trades? Well, all of the other option insanity trades or option insanity trades that are not similar to this one. So this one's going way out in time, right? And so most of them we're talking about 2, 3, 4 days in length. And so one of the reasons that I'm able to go out in time is because I know that I'm pushing the break even way to the upside, which means that the market has to go way to the upside. And I already know, if it's 2 weeks down the road, 3 weeks down the road, 4 weeks down the road, if the market's way up here, volatility is going to be coming out of those options. So I don't have to worry about what volatility is today if I can go way out of the money, because if the market does move up to that point, I know then the volatility will have come back down. So, like, for example, today we can't really put on any short-term option insanity trades because the volatility is up. And if the trade ends tomorrow and the volatility is still up, then we don't capture that increased rate of time decay that occurs on the Monday option, or the volatility crush, if you will, occurs on the money option. So if the market does move up tomorrow, they will drop the volatility in the Monday options, but it might not be as much as it would normally be if the market had not moved down first. Right. So this week, that's been the issue, is that all week the market's been trying to move down a bit. All right. So uh, let's see here. This one, this particular option sanity trade, and I'm going to spend just a little bit of time on that since it is option sanity day. But this particular option sanity trade, we went all the way up to 404. Of course, the market was trading at around 393. This was before the market drop. Ended up exiting 2 of the shorts at 50 cents and creating this monster bubble, and pushing the break even all the way up to about 409, 410. And ultimately what that was doing, so I by exiting 2 of the shorts at 50 cents, basically locking in a small profit on the trade on 2 of the shorts, I was able to maintain a $2.50 credit, or $250 if the market tanked. Of course, the market did tank. The long option is now only worth about 10 cents, and so it's really worthless. The 404 calls are worthless, so those are all exited. So basically, I've got I almost captured the $250 credit, and I held on to the long because it's only worth 10 cents. And if the market shoots up, then I might be able to get out of it for something extra. Then I turned around and I tried to replace this. Now, of course, as you know, the option sanity is where we're selling Monday and buying Friday, and creating it would be considered like maybe a reverse diagonal, where you were selling the further away expiration and buying the closer expiration. And that's because starting on Thursday, so starting today and moving into Friday, normally in low volatility market conditions, and when there's nothing going on Monday to hold the value of the options higher, so no major economic reports or announcements scheduled, et cetera, then what happens is they really take out the volatility of those Monday options on Thursday and Friday. So we're taking advantage of that with the option insanity trades. And again, this one's going out in time, so I know if the market's going to go up, the volatility is going to come out. So I exited this one and tried to get into another one. And what happened with my other one is, because they don't allow you to do a 5-to-1, right? So we have to have a margin hedge. We have to buy the margin hedge, which means you have to buy the April 5th. And I think we bought the 430s on this one. And that creates a scenario where you're not technically naked 5 short calls in SPY. Now, with this, I try the 5-to-1 cannot be placed as a spread now. The maximum number of contracts in a leg in a spread can only be 3. Otherwise, they just set the order there, and it just sits there So you can't do a 5-to-1 as a spread. You have to do a 3-to-1 as a spread and then add the 2. And so what I did is I put in the 3-to-1 as a spread, and then in order to add to the shorts, only I didn't do it on a sequence basis. I just put both orders in at the same time, thinking that they're probably going to get filled at the same time. And if not, it'll be really, really close. And so what happened is I sold 401s, April 12th 401s at $1.25 a piece, 2 of them. And then my 3-1 spread didn't get filled. The market came down and my 3-1 spread didn't get filled. So I was stuck with 2 of the 401s from $1.25, and basically a $250 credit without on just 2 of them and with no long. So I just held on to that one at this point, and I may or I may not add the 3-1 spread at this point, because they're down to like 50 cents or something like that. And if the market comes back up, then I may add that into it. Obviously I could have added a long at a cheaper price. All sorts of things I could have done here. I could have added a long at a cheaper price. In fact, let's see, the 412s right now. Let me see if I can't find the 412s. I've got all my trade partner windows occupied oh, there we go. So the 412, and I would, since it was 401, I'd look at 393, and I'd go 49. 49 on expiration would be the long, and it would be a 393. Can't talk and do anything else at the same time. So I'm looking at the options here. So the 393 would be 211 right now if I were to buy them. And so my total credit, if I have 2 shorts from $1.25 and I buy this, let's say for 210, then I've got a credit of 40 cents. And then I can add the shorts if the markets move up. Not doing that yet. I'm just kind of waiting and watching, because the market's down. In fact, if I wanted to, I could add an entirely new option Insanity 5-to-1 trade, and we may take a look at those here in a minute. Okay, so let's take a look at shoot, I meant to put this one in there. Hang on one second. Let's see if I can't find that. Here we go. So that's not the one. There it is. So on Monday, we talked about the profit stacking, and in a way, when we get to the cash flow spreads, it is much like profit stacking. And the profit stacking is simply where you take one off and add one back on, take one off and add one back on, take one off and add one back on. And most of that has to do with market movement, right? So as the market, so if we, here in this example, short 2 396s from 258. If this is what we're in, I did get filled on the order that I had placed during the call on Monday, and I'll get to that one here in a second. But what we're doing is basically exiting the 396 or one of the 396 calls at a profit, with the intention of putting it back on once the market moves up. So we have 2 ways to take one of the shorts off at a profit. If enough time passes, then eventually we'll be able to take one of the shorts off at a profit. Or if the market makes a favorable move to the downside, then we'll be able to take one of the shorts off. And of course, the market did make a favorable move to the downside. So on this particular trade, the credit was 167. And that means that minimum to exit one of the 396s, we needed to exit it at 167. And that creates a scenario where we have taken a small profit on one of the shorts, and we have a 0 credit here, right? So I'm going to reconfigure that so that it's not, there we go. So that's the trade that we're left with, and we're just simply waiting for the market to move back up so that we can resell a 396, and then that creates that trade, right? So pushes the break even up, pushes the profit potential up, et cetera, et cetera. All right, so we did that, and on several different trades. And that's where it's at. So let's see here. I'm gonna bring these spreads down, so that you can see here. Maybe we'll see if it populates. All right. So here is the 396 trade. Okay. Let's see here. Whoops. There we go. We focus on that one. So here's the 391, 396, 396. Well, that entire trade right now, with the market trading about 387.50, that entire trade right now is at $1.22. But as of right now, Trade Partner does not show when I exit a partial leg, and we're still trying to figure out how to properly account for that and keep it in the spread box. So what we're trying to do right now, I'm just going to tell you what we're planning on doing, and if you have any input on this, any ideas or any suggestions on it, that'd be great. So here's what we're doing. If we enter a spread and then one of the legs exit, we stick the exit leg down here at the bottom and show closed legs of this spread. And then it'll keep track of that and then show us where we're at with the current open position. So that's the plan at this point in Trade Partner, to be able to better keep track of the progression in the life of a spread. And I think that'll work with what we're trying to do. But as of right now, it doesn't show. So all it shows is that I'm still in two of the short 396s, and I'm not. I got in at a $1.80 credit, got out of one of the shorts at $1.80, and that's what you see in this right here. Okay, only we didn't resell, right? So this is what you see. So these aren't the exact prices that I was filled at, as you could just see, but it's the same thing. It doesn't matter whether they're the same fill prices or not, as long as you have the same credit. And it's actually a $1.80 credit, not $1.67. So this is just what we were looking at before I actually placed it. And then by the time we got it placed and filled, it was trading at $1.80, and that's where I got filled at. And that was at 3:03 Eastern. So that was like 3 minutes after our call officially ended on Monday. All right. So this is basically one of the only trades we've got going on. There was another trade. Nope, I'm not going to bring that one in. Actually, I am, but just not yet. So here is this trade right here. Is actually one of the cash flow spreads. trades that I have on, and so we'll discuss that here in a second. All right, so let's switch gears. I wanted to at least address the trade that we got into on Monday and show you where it's at. Obviously, we're down here 387.50, and most likely we're not going to get back up here to where we're going to be able to resell at 396. However, it is 4.5, and so that's a couple of weeks away, and going into Easter and the first calendar day of the month is bullish, and so we very well could get to that point where we can resell that 396 at some point. And if I wanted to, I could sell a 394. I could sell 396. I could move up here and try and sell 398. It doesn't have to be the 396 that we keep adding to. You just have to understand what the ramifications are by selling a 394 as opposed to another 396, because you're actually creating 2 strike difference now between your next short and the longs, right? So you do have to take into consideration that. All right, so that's the trade that we put on in Monday's call. And now let's switch gears just a bit back to option insanity, and I'll show you why we can't get into any shorter term option insanity trades, and why it's really not worth our time to really spend a whole lot of time on that today, since we're not going to be taking any trades in that. How did that happen? Oh, there it is. Okay. So same window. I moved the window and then I looked for it. I'm like, where did that window go? And it was the one that I moved. So let's move down to, all right. So here is a common option insanity trade. This is why I tell people, and everybody wants a trade, and I get it. I wish it existed that way, but everybody wants a trade that you can just put on every week, the same thing, no matter what, and just be consistent like that. And the problem is that is a pipe dream. It's not going to happen. It's never going to happen. It's impossible for it to happen because you can't get the same price on the same spread at the same time every week. It's just not going to happen. And if it does happen, it's probably not a profitable spread. So, so you have to have a price on every single spread that you're getting involved in. You have to be able to get involved at a favorable price. That is the key. That's the bottom line. And the problem is that when market conditions change and relationships are change because of whatever else is going on, you can't get the same price on the spread all the time, right? And so this is one that we were taking a few weeks ago, maybe closer to a month ago, maybe even longer than that now that I think about it. But it's where it was a 1-1-2 trade where the shorts split the middle, split the longs, right? You can see that. A long 384, long 394, and then the 2 shorts split the 2 longs, and that normally creates this big bubble, and we normally do it at a small credit. Every now and again, you can still do it at a small debit, but then you create a little bit of risk to the downside and a little bit of risk to the upside. But now look at this. This is a $1.25 debit. That's what that spread is trading at right now. And this is the one that ends tomorrow. This is not a good price to get into this spread. Period. End of story. You cannot force your way into these types of trades. They either exist, either the price is available or the price is not available. And so as of right now, the price is not available. And that's really where we're going at with this. and which is why it's very difficult to get into an option insanity trade at this point, or a short-term option insanity trade that expires tomorrow. Which, by the way, this is normally a really good week to be able to do that. It just happens that the market has come down this week, inserted some volatility into the trade, and that's it is what it is, right? All right, so here is a report from last year before the pandemic. So you can kind of see where these are at, and these are some patterns that you can kind of look at on a weekly basis and see where the credit is at. But this is a little bit deceiving right now. Not these, but I'll show you here in a second. Of course, last year the market was trading at around, let's see, these strikes are at 317, 325, 320. So before the pandemic, this is where it was going. You see it's 18 of 20, right? 1820, 1820, 110 of 20. And we're just going to go here. Here's one that I like putting on because you have just this really small area where there is a little bit of risk, and that's where the long is at. Right, so it's a long 316, long 321, and short 2 of the 318s. And that creates a $1.43 credit, right? And the risk is here at this point, and either just a little bit to the right and a little bit to the left. If they don't drop volatility quite as much as what this projection is showing, and this is actually a very realistic projection on the trade. And so these are trades that I like. Now you move down into the 318 area. If the market moves from 322 to 318, right, then the volatility is not going to drop as much, and this profit bubble is probably closer down to around $75, $50. And unfortunately, there's not a calculation on the planet right now that properly calculates volatility in SPY based on whether it's moving up or moving down. And so you have to go in here and change it, say, and just assume that that's what's going to happen, because that is normally what does happen. So the profit isn't as good in this area, but it is, it's not that bad, as long as the volatility doesn't remain really strong in that particular option. All right, so now let's take that same pattern, if you will. It's an option insanity pattern, and what was that spread difference? It was a 5-point spread difference. All right, so let's take that same pattern and take a look at where things are at right now. Okay, so here it is. Same pattern. Nope, that's 6-point. Sorry. Let me pull up the 5-point. Where are you at? I know it's here somewhere. There it is. Here's the 5-point. So you can see, using the same exact pattern, 326, 326 are the longs, 2 of the short 329s. So you have 5-point difference between the longs, and then the short is the two shorts are 2 points above the lowest long. Okay, that's the pattern I just showed you on that old report from 2020. And you'll notice here that the price on this is at $1.31, right? So the credit that we were showing was $1.43, right? Let's see here. All right, so this credit right here, $1.43. Everybody see that? Same pattern, same exact pattern, $1.43. Risk is at the highest long, which is 321. Okay, so we know what this is going to look like. at a $1.43. So this is a $1.31. So that's not too bad from that standpoint. And then we scroll down, and here's a $1.44. So here's one that's exactly the same credit as the example from last year. What's the issue with this, though? Any idea what the issue with this might be? The issue with this is that we're trading at 388, and tomorrow's long is still trading at a $1.65. So that poses a problem. And another problem, so we're right at the 388, which is where the risk is, right? And there's still a $1.65, and that's with a day left. So if we get into this thing and the shorts here, the market moves down, let's say to 385, they're going to be holding on to the premium on these more so than they were going to last year, because even though we got the same price as this example last year, we have a whole different situation going on with the circumstances of what created this price. So even when it's the same price, it's not an absolute guarantee that that you should be trading the same option spread or in the same way. And so you have to understand how it works. And that's what I mean by it's a bit deceiving, is that, yeah, I can get the same spread here at a $1.44 credit, but it's not the same thing because of the probability, especially if we stay here at around 388 or even move down. The probability is that they're not going to be dropping that volatility as much tomorrow. All right. So that's why no option standing trade, even though I can get filled on this. Now, it would be a great learning experience for you guys, and I suggest doing this all the time, to watch a spread that you think might be a good spread. Don't take it just because you think it's going to be a good spread. Watch it and see if it turns out the way you thought. And if it does, great. If it doesn't, then you'll have learned something, right? So we'll watch this spread tomorrow, or I should say, I'll watch this spread tomorrow, and I'll report on it Monday, and then we can discuss it just a little bit more on Monday. All right, so let's now switch gears into the cash flow spread. Cash flow spreads in SPY. So what is the cash flow spread? Well, it's actually very similar. It is almost like a profit stacking trade. And there I go. I lost my window again. It's almost like a profit stacking trade. The difference is that we're not waiting for time to pass by. We're not waiting for the market to make a move. We're actually doing it based on time. Okay, so I'm going to pull this new graph over. I told you guys we cover a lot in these, so just bear with me. So here is the graph of a time warp, a cash flow spread, which is utilizing the same time warp concept that we use on all of our stuff. It's the same concept, just different application. That's all. This is, by the way, I once had a gentleman, I forget his name now, but he was really high up into the option world, New York scene, into the institutional stuff. And when he saw this spread, this was probably 5 years ago, when he saw this spread, he changed his entire approach and began focusing on this, and ultimately did really, really well with it. And so it does require a little bit your willingness to take a little bit more of a risk if the market makes a big move in a short period of time. And there are ways to mitigate that a little bit, but this is ultimately what this trade is doing. This is taking advantage of the fast rate of time decay on the nearby options and leveraging the much slower rate of time decay on further options, not 2 days, not 3 days, but maybe 2 weeks, maybe 3 weeks out. In some cases, you can go even further than that. There was one option cash flow spread where I was able to buy a 3-month option and sell weeklies against that, and that's exactly what we're doing. Only we're doing it intra-week, right? So here's the process of a cash flow. In short, 329, 389 call from 162, and I'm in a 416 expiration. Long 394. So it's a 5-point strike. We'll talk about that here in a second. And that's from 302. All right. So I created a $1.40 debit on the trade. And this is one of the things, it's one of the negatives, in my opinion, about this trade is that we are creating a debit. But if I've got a bunch of other credit trades, then I'm not too worried about it. And it's a very high probability that I'm not gonna, we're not gonna see the trade on the first time that I place it. Watch the market move down. All right, so here's the plan with this thing. We put this on for $1.40 debit, and this 394 call is going to do a really good job of holding its value over the next couple of days because this expires on 329. All right, so the 389 calls expires on 329. So if it expires at, let's say, 389, if the market's at 389, then this is going to be worthless or very close to worthless. So we'll exit it, and then we'll add one. We'll add the 331. And if it's market's trading at 389, that'll have 2 days left on it. It'll be easy to get a $1.35. More likely, we'll be able to get like a $1.85 on it, but we'll just stick it at a $1.35. We're going to go ahead and exit this one. So we're just going to go through the process of how this works. So it's very similar to profit stacking. So let's say we get rid of that at 10. And now all of a sudden, with one iteration, we've created almost a credit on the trade, right? Almost a credit on the trade. And we've pushed up this profit potential, and we've pushed away the risk to much further up. So I'm going to change the perspective here, and we'll just see how far. All right, so now instead of having a risk of $500 or $640 if the market skyrockets, because we have a 5-point strike difference between the short and the long, and we end up getting rid of one short, adding some more premium, so that creates almost a debit. And now the maximum loss to the upside is dropped to 500, but it's way, way up there. And so if the market moves way up in the next couple of days after we from between 329 and 331, if this is the sequence of how it works out, then it is what it is. There's risk on this trade. But if we're able to do this again, so we sold this one, right? So we'll go ahead and exit it. So let's say the market just kind of stays the same. And of course, that's not what's going to happen, but we'll for illustration purposes of seeing how it works. And then we turn around and sell the 4-1. And we'll probably be able to get a $1.35 for 4-1. That's the next day, or actually 331. So yeah, that's the next day because 4-2 is Good Friday. But once we do that, all of a sudden now we have a decent credit on the trade. We have a $400 profit potential max. We've collected. We probably have, between the closed trades and the open position, we probably have a pretty significant profit on this thing. We lower the risk again. We push the profit the break even further to the upside. And look how many times you can do this against this one long, right? I can do it on 4-1. I can do it on 4-5. I can do it on 4-7. I can do it on 4-9. I can, in fact, there's, how many times can I do this? Let's see here. On the calendar, there is, so 4-9, 4-12, and 4-14 if I wanted to. So that's 1, 2, 3, 4, 5, 6, 7, 8, 8 times that I can sell a call against this one long if I wanted to. 8 times I can bring in premium against this one long if I wanted to. Now I'm not going to do that because the price will move, and at some point I'll get out of the whole thing and restructure it. And at some point, this 394 begins to lose value at a faster pace, and so I would want to restructure it anyway. And so I might get 3 or 4 or 5 iterations down the road, bank a $200 or $300 profit, and restructure it based on where the market is at, and go further out with the long, and start the whole process over again. That's what a cash flow spread is. It's where you are flowing the cash through the short-term strikes. This is very, very similar to profit stacking because we are adding, right? We're adding, and we're lowering the risk, lowering the risk, lowering the risk. All right, so you can do this with anything. You can do this with a calendar spread. You can do this with a smaller diagonal so that you don't have quite as much risk. You can do it out of the money. You can do it to where the long is not quite as far out, and you're not going to be able to sell quite as many shorts against it, but because of it's not quite as far out, you can create a credit, maybe with the first trade, et cetera, et cetera, et cetera, right? So there's no limitation on how this can be applied. Again, very much like profit stacking. The only question is, what is it that you're wanting to achieve on this, right? So let's do something here, and let's just create a calendar instead. All right, so I'm going to exit that, exit this, and I'm going to change, whoops, I'm going to change the strike. So we're going to actually just do a longer term calendar, which is going to be quite the debit here. All right, so here is the calendar, and we're going to do this. It should be about 8, actually. And this is a one-day iteration, right? So this may or may not. So this has, risk to the downside, has risk to the upside. The debit is $394. So that is the risk to the downside, a little less than $400. And that is the risk to the upside, a little less than $400. But it has to go so far down so fast that there's no extrinsic value on this option that is about 3 weeks out, not quite 3 weeks out. So the probability of hitting this $400 loss on a single trade is almost impossible. It's not impossible because the market can crash, but if the market crashes, there still might be some extrinsic value on this call because they've shot the volatility up. On the flip side, very, very unlikely that in 2 days you're going to go all the way up to where you can hit, $400. This one is statistically an impossibility to the upside. Okay, so that's what we're dealing with. Can you suffer a small loss? Yeah, but it's a 394 debit. So here's what we do, right? Same thing. And you can create a 1-point diagonal if you want to go a little bit different than that, right? So we're going to go 0.10 again. And then we're going to sell the 389 at 1. We'll assume 135. right? And now here's our trade. Okay. And then so that's just with one iteration. We have a nice little bump there. And then we are going to exit that one, assume that the market stays relatively the same. And if it doesn't, there's all sorts of things you can do, but we'll go 1, and then we'll sell that one. And if we can just do this 2 more times, we've created this nice big profit graph. And this is based on exiting on 4-1, which is the last one that I sold here. So this is like profit stacking in that you're pushing the profit up and you're pushing the risk further out and away. And on this example, we have now a $1.24 debit. So technically, there's still a $120 risk on this trade, but it's way to the upside and way to the downside before that happens. So why would I be willing to start with a debit on this trade? Well, the short answer is because I know that that this is really a short-term risk that I'm taking, and 329, that's Monday, so I'm going to replace this short on Monday, and because of that, I know I'm going to be decreasing the risk immediately and increasing the profit potential immediately. All right, so let's do one more thing and just create a small diagonal. And we'll go, let's see, we'll go 391. And so that one will create a 265 debit. So now $265 is the absolute max loss, and that's probably going to be closer to 18. But 265 is now the max loss, either to the upside or to the downside. And again, to realize that max loss, the market has to make a big move in a 2-day time period. And so the first thing, again, we exit, and then we sell again. And I'm going to get, and I know the first question is, what if the market moves up? I know that. I'll get to that here just in a second. So here's the first iteration. And so this is, literally in 2 days, and you very well may be able to take a $100 or $200 profit on this trade, in a small amount of time, right? And so that's why I would be willing to create a debit on this, is because I know I'm going to be replacing that short, and I'm going to be lowering that debit as I go. So if I do this one more time, now I've got a credit on this trade, is the way it's going to work out, or the way it would work out if I were able to do it one more time. Right, so we'll do that. And then there's our trade. We have a 5-cent credit, no risk to the downside. Technically $200 risk to the upside, $195 risk to the upside, but it's way up there, like way up there. So again, big profit zone. It's just a matter of where we're at on this. Now, let's say we have to exit this. Let's say the market moves up to like 391, right? So we have to exit this at $2, right? Well, this long is also going to be worth more. And let me do this. And 0. So we already know this long is going to be worth more, and we already know that we're going to be able to sell this 389 for more, right? So if we're trading at 391, we're going to be able to sell this for probably, let's say, 280. And we do that. So here's that trade. Yep, there. So there's that trade. So, you can either sell the same one, especially if there's extrinsic value, or you might say, you know what, I'm going to do a 390 now, and I'm going to do 390. I'm probably going to bring in $1.50 because that'll be a Monday, Wednesday thing, and oops, 391 be $1.50. So you can do this, but when you do that, you are creating a scenario where you have more risk to the downside, because now you've created a scenario where you can't make back the movement to the upside, right? You can make it back $1.50 of it, but if it moves back down, then you may have to move that strike down. There's all sorts of ways to do it. There's not necessarily an absolute right way, an absolutely wrong way. It's all about how much extrinsic value you are bringing in and where you're pushing the risk to, and that's the key. Okay. All right. I know that was a lot to begin with, but it's one that personally I love the strategy. You just have to be really consistent with it. So let me show you now. Let's see, that's option. Let me find it here. Not that one. Spread position. Where are you at? So I did one that was in, let's see, is that it? Yep. So I did one that was in the money. Looks like we're trading about 388. And this is it. I did one that was in the money. And whoops, my goodness, stupid thing gets stuck. Did one that was in the money, and you can see here it's at a $40 profit. This is 326, 385, and the long is at 389. And I did it from a debit of 80 cents. So there's not a huge debit on here, so not very much risk to the downside at all. But there was $580 or $480 risk to the upside if the market skyrockets. But I did it because I have several other trades that around the 392, 393, I'll replace those. So that's this one. And as you can see, it's got a small profit on it right now with the market trading about 388. So what happens tomorrow? This expires, and I will resell the 385. I sold it with about $1.50 extrinsic value on that 385, so I will have collected the $1.50, and then I'll sell it again. And right now, if we take a look at the 385s, what are those at? For 329, the 385s are going for, they're going for more than that. I've got a wrong price on here apparently, so let's see here. 329, 482. So we're trading at 388. 385s are going for 482. That's $1.82 in extrinsic value, is what that is, right? So come tomorrow at some point, I'll replace that 385 and I'll bring in another, large, hopefully large amount of extrinsic value on this thing. And I just go through the process and wait, and it's kind of like a profit stacking deal. All right. All right. I know y'all are going to want to see more of that, and we will include some more of that in later calls. Obviously, if y'all are really interested, then we can explore that more sooner as opposed to later. All right, let's see what questions we have. In exiting an expiring crazy calendar spread that is out of the money, should one keep the longs? Mark, if you have longs, so if you're exiting crazy calendar and the market's down like it is, and you're exiting, if you have a profit, and by holding on to the longs, you don't give back that profit. Yes. So if the longs are basically worthless, excuse me, yeah, I'd hold on to them. If they're not worthless, then I would absolutely get out of them. If time permits, you go over advanced smart fill, specifically stop adjusting, for example. So Michelle, we're actually, quite frankly, the stop adjusting is the same thing in the same thing. Let's just take a look at this here real quick. Smart fill. Let me pull this down. There we go. All right, so this is the same thing. This cannot get the windows. There we go. All right. So when I say start at, let's say 550 and end at 450, and then I go to 0.02, 15 seconds. It's basically the same thing as hold in the simple. So, quite frankly, the advanced is, I don't ever even use the advanced. I use the simple because the simple does 99% of what I want to do. So it's the stop adjusting is the exact same thing as hold. As soon as it hits the price, it stops adjusting and it either holds or it cancels. All right, so same thing. All right, could you please explain the day trading rule, as I recently had a problem with Schwab when I could not exit a calendar spread as a spread, and when I bought back the short leg, I could not sell the long leg. And later when I got on the phone, causing the market move against my long position at the time, they thought it was only on SPY. Philip. So the day trading, so if you have an account that's less than 25,000 and you make 3 day trades within a 5-day period, they're going to prevent you from making another trade. In fact, they're going to warn you and they're going to say, don't do it again, blah, blah, blah. It's the stupidest rule on the face of the planet, made by ignorant people who don't trade. That's all. That's the best I got for you on that. So if you run into a situation like that, first of all, they should never, ever, ever, ever prevent you from exiting a trade. If they do, they are liable. Period. End of story. So if they lock it to where you can't get out of a trade, they're liable, and you should absolutely scream bloody murder on the phone with them. So that's the first thing. The second thing is that if you run into a situation where you got in, let's say you get into a 395 and then you got out of a 395, then you got in a 395, then you got out of 395, and all of a sudden you're hitting up on that day trading thing again, go into a different strike, 396 or 394, or instead of getting out of the strike that you just got into, get out of a lower strike or put on a new trade at a lower strike. You'll create the same thing, and it's not considered a day trade. So there are ways around it. If you ever run into that situation again, just look at a different strike. It won't be exactly the same trade, but it'll be really close. All right. Let's see. If I'm in crazy calendar, says 4132 credit, and I can get out now with that full credit and take another trade, should I wait in case the market goes up? Mark, that's a great question. So you can get out of your credit now. It ends on 4-1. It really depends on how far up the mark the trade is. If it were me, I'd get out and I would look for another trade. And that's the way I would, unless it's like super far up to the up. So what you don't want to happen, especially since it's 4-1, what you don't want to happen is you don't want the market to move up really high, really fast, and then watch your profit go away and not give you an opportunity to exit again. Let's see if it's 4-1. So that's a week away. So it depends on how far up it is. That would be my answer. Okay, because you have no risk to the downside, right? You're going to make your $32. The only question is, what is the risk to the upside if the market screams to the upside? Let's see, place order nanoseconds, the next one. It stops adjusting. So yes, after one time, it would stop adjusting. That's correct. When this occurred, I could not put on any order online, no matter what it was. Yeah, Philip, I would absolutely, I would scream bloody murder to them. And yeah. All right, let's see. Ryan, please send me info on your hedge fund. Alrighty, Dell, I will do that. Anybody, if you're interested in the hedge fund, just shoot me your email here in the questions box, and I'll put you on the list. As a new member, can you tell me the best place to learn basics of what you're teaching? Isn't there some place on PDS Trader site where we can be introduced to the basic structure of terminology we're discussing? Dawn, great question. The first thing that you should go listen to is the power of PPD. Go watch that video. That is the basis of virtually everything that we do. Do you guys have an option class to start from the basic? So I'm getting that a lot these days. So clearly it's something I need to organize. From the beginning. I've got all the lessons. It's just a matter of organizing them, I think. But the main one is power of PPD. When the market moves up and the short strike gets ITM, are you adjusting the strike or stick to the same price? Mike, so I read your mind. I think I answered your question, and that you can adjust the short strike, but you would then be kind of adjusting where the risk is on the trade. And if it moves too far up and you stick with the same price, you're not going to be bringing in any extrinsic value. So if the market moves too far up, I would move my strike up, but I wouldn't move it up a whole bunch. I would move it up to where I'm bringing in a decent amount of extrinsic value, and then stick it there. Hi, why did you increase the volatility 18% to decreasing it usual? Nuno, great question. So here's why. So somebody asked, why did I increase the volatility on this trade? It was at 16 and I increased it to 18. And the reason I did that is because this is a 416 expiration, and I'm only concerned about where that volatility is going to be on 329, right? So so I know that the volatility is going to be a little bit higher than what it's projecting it to be at expiration on 416. So that's why I did that. If there were only 2 days left on this thing, I'd be popping this thing down to 10, right, is what I would do. All right, but because there's so much time left on it, it actually goes the other way a little bit. Thanks and congrats for a great webinar. Thank you. I'm glad you enjoyed it. Do you have a training video on your cash flow spreads? Dell, not for SPY. I've done cash flow spreads for stocks, but not for SPY. If you're a member of the All Access Pass, then I would contact support and say, "Hey, I want to watch the cash flow videos. Point me in the right direction." When creating an action group to place a calendar spread order, should the debit price be set according to the mid-ask price? That's a good question. The answer to that question is, how bad do you want to get filled? Or what's the price that you want to pay, right? So when I get into a calendar, it's usually because I only want to get into that calendar if I can get a very specific price. And so I will put that price in there and I will wait for it to get hit. And if it doesn't get hit, it doesn't get hit, type deal. Let's see. I was trying out some combinations to create credit diagonal spreads for financing the calendar spreads. I was able to create a call and a put side spread with same credit independently. Long question, so just let me get through it here. You can choose. Yeah. There is no set way to pay for calendars. He asked a very specific question about paying for the calendars. There's no absolute one single way to pay for the calendars. What you have to do is you have to you have to be willing to accept the risk, and you have to understand what the risk is of however it is that you're trying to put to pay for those calendars. So, for example, I can create this really big credit spread with calls, or I can create a credit spread with puts and pay for that calendar, but it creates a different risk. And so do I, I don't want to pay for my calendars um, and not accomplish the whole purpose of me putting on the calendars in the first place and paying for them in the first place, which is to reduce the risk of just putting on calendars, right? So you got to make sure that you're not working against yourself with however you're doing it. Can you put on a real cash flow option as the first and watch it in future calls? So you want me to put one on right now? Is that what you're asking, Barry? You betcha. What do you want me to put on? A cash flow calendar, a cash flow diagonal, and I'll put one on. Scott, that is a great word to use for this, because that is the mentality of most option gurus out there. And here's the question. He says, on today's new strategy, how do you defend if the price rises? Do you roll the long call up or out of time, or you just take a beating? Take a beating. So Scott, I don't consider, if the market moves up, here's in this situation, I'm just going to back out of this, right? Cancel. Whoops, I should have done that. So I'm going to back out of this. So let's say I'm into, let's say I do that. And I got to get rid of that, right? So if I do that, it's a 4-point spread, right? So if the market moves up to, let's say, 392, 393 by 329, I might be losing $50. That's not a beating. Even if it moves up way up here, I don't know why that switched. So it's actually going to be something like that. But let's say it moved up way up here to 400 and I lose $200 on the trade. Is that a beating? Right? So if you're considering something if you end up taking a loss on a trade and you consider it a beating, then you might want to put on a different trade that has less risk, right? As far as defending, so I'm not a big fan of that mentality. I know that's mentality, especially with iron condors, because if an iron condor moves against you, you're going to take a tenfold type loss often, and the whole thing out there with iron condors is adjustments, 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 adjustments. You can make adjustments, but I don't like the sense of, hey, I'm trying to make I'm trying to figure out how now to not take a loss. That's not what I'm trying to do. I'm trying to put the long-term probabilities in my favor. And so any trade that I put on at the beginning, I accept the risk of that trade from the beginning, period, end of story. I don't freak out if that trade makes an adverse move. I got into it understanding what I'm going to lose if there's an adverse move, and I'm willing to accept it, because if the market makes a move, there are other things that I can do. I can put on another trade, et cetera, et cetera. So I'm gonna, if I'm into this one and the market moves way up here, I'm not going to do anything to quote unquote defend it. I'm not going to do anything to try and adjust it. I'm going to do what is right for that, whatever that trade allows me to do. And in some cases, it means just staying in it, and continuing to sell that short, because I've got now, if it moves all the way up here and I'm realizing the max risk, or very close to the max risk, what have I got to lose to continue to sell shorts? And eventually maybe we'll see it move right back down, and all of a sudden I'll have a profit, right? So that's my mentality. Yes, this is the triple play options webinar. That is what this one is. We talk about all types of volatility, low, high, and in between. That's what the triple stands for. Triple play means what do we do in low volatility? What do we do in medium? What do we do in higher? Last Monday, I placed an order for a bearish, bullish two positions. The smart order was split in two. First two bearish and second two bullish spreads. Partially filled. And after 20 minutes, the second bearish together with order for two bullish spreads. Constantino, no, it is not common that the market only fills one of two spreads. It's very rare that you'll get a split fill on a SPY spread. Very rare, or at least it is with me. Let's see here. So John, I'm not sure if you came in late or not, but these calls are cumulative. You're not going to learn everything about these trades on one call. So it's a matter of just continuing to watch and continuing to attend. Is there a 5-to-1 option in Sanity Finder and PDS Trader? Eli, yes. We're having a slight data issue with SPY data in PDS Trader right now, but you can take a look at Trade Partner. Right, so here's Trade Partner. Whoops. My mouse is going crazy. And here's a 5-to-1 option insanity pattern. And I'll click on that. I'll change the dates to, let's say, let's just see what's available on 4/9, 4/12 right now. So we're moving up. And there we go. And let's go with 377, actually. All right, so there's that. I'm going to start with 385 and 05 and buy ones. And that's how you do the 5-to-1 in trade partner. Trade 405 through 97. That is a few weeks out, and placed 245 credit. Can you discuss the best way to profit stack enhance in a situation where the market drops? Is it better to generally to add another long versus get rid of some of the shorts, or just sit tight and do nothing? Seems like the big profit bubble from adding an additional long will give me more future flexibility. So that is exactly right, Jeffrey. If you can add a long to that mix at a fairly low price, you will push that break-even level way up there. You'll create a nice big bubble. But at a 405, 397, man, that break-even level is already way up there. So you would actually probably push it to about 412, 411, 412, somewhere around there by adding a second long. Obviously, you would decrease your credit by whatever the cost of that long is. Is there a video or webinar explaining the strategies? So it's a bunch of strategies. This webinar is about looking at the current market conditions and current opportunities. And so there was a seminar that was held last July. If you want, if you're interested in that, you can contact support or call Spring, and she'll let you know what is necessary to access that. My short is your short is 397. Your long is 402. So that's 5-point difference, and that's a Thursday, Monday. Is that correct, Mark? If that's the case, surely you can get rid of those 402s for like nothing. And I would look at maybe getting rid of one or a couple of the 402s of the shorts and then putting them back on if the market moves up. That way you increase your profit potential at that point and reduce your risk. So again, for clarity, my shorts in a crazy calendar trade expire tomorrow. They are currently at, should I X? Yes, Richard. If the longs are worthless, just hold on to them. You never know. All right, Guido, I will send you info on the fund. Brent, I'll send you info on the fund. Raj, I'll send you information. Kenneth, I'll send you. All right, perfect, Mike. I did answer your question. Excellent. Don, put your email address in the question box, and I'll get you information on the fund. A diagonal, Barry. Okay, I'll put on a diagonal, and we'll just watch it here just in a second. Can we start multiple calendars around the current market price and keep rolling the shorts and adjusting the strikes as the market moves? You can. You just need to make sure you don't adjust the short strikes too far away, because you'll create a risk where one didn't exist, or more of a risk where it was smaller. Sorry about it again. Has your hang on one second. I am, while I've got, so while you're reminding me, Juan, I'm going to go ahead and I'm going to shoot the programmers a note and see where they're at with that. I'm just typing, so I can't talk and type at the same time. On pushing there's to the free version of TP. All right. So I sent them a note. All right. Also, no margin required for these debit trades. No extra margin is required for these debit trades. That is correct, Dean. I have 2 trades from Monday up $100 and $130 and risk-free to the downside, and upside I should hold for the bullish April 1 market or cash out. So again, Lewis, that kind of totally depends on how far up that is. I'm never, ever, ever opposed to taking a $100 profit or $130 profit. if I've got it, and then waiting for another trade to develop. You're welcome. All right, Robert, I will send you info on the fund. Perfect, Don. I got your email address. Alrighty. Looks like I got everything. Okay, Barry, let's get to you. Let's put on one of these bad boys. I know we're an hour and a half into it, but that's all right. You guys are worth it. Let's see here. I'm going to place trade. I'm going to put on an out of the money diagonal. That's what I'm going to do. And I'm actually, you know what? I'm going to do it tomorrow. I'm going to do a tomorrow trade. So I'm actually going to roll it tomorrow, and I'll do a 416. And I'm going to do a 416, although you can most certainly do one that's shorter time and create a smaller credit. So I'm going to do a 390 and a 392. So we're going to make it a really small. And so this is it right here. All right, so we're going to make it really small, 390, 392. But my risk on this trade is actually 321 to the downside and 521 to the upside. Now the market has to skyrocket, and tomorrow I'm going to be able to sell another 390. So I'm going to bring in $1.08 today, and then I'll sell tomorrow. I'll sell 329s. Okay, got it? All right. Let's see what we can do here. I'm going to put it at 323 just to make sure we get filled. And hopefully I don't have other trades that are going to prevent it from being, all right, perfect. It's placed. And let's see here. All right. That is placed. I will stick this in the queue for us to watch, and we'll take a look at it again on Monday. So tomorrow I'm going to sell Monday's option, and Monday during the call probably I'll sell Wednesday's option. And we'll see where we're at, because we're probably going to be moving to the upside a bit, and then we'll look at different options, and you'll be able to see. I was filled at 323. So spread is placed. All right. Derek, I've got your email address for the fund as well. All right, perfect, guys. I think I got everything. Last time somebody asked a question and somehow I missed it. And so if I didn't answer your question, you can go ahead and type it again. I'll be here for another 30 seconds. Otherwise, that's it for today's call. Hope you enjoyed it, and I will see you on Monday.